Options are one of the most misunderstood financial instruments in existence. Most people hear the word options and think of one of two things: either a gambling tool used by day traders trying to get rich overnight, or something so complex it is only for professional Wall Street traders with advanced mathematics degrees. Both of those impressions are wrong, and the misunderstanding costs ordinary investors real money. Because used correctly, options are one of the most powerful risk management tools available to any investor with a standard brokerage account. This is week 13 of the Algorithm Investor and the third episode of Series 2. Today we are covering options basics, what they actually are, the difference between calls and puts, how pricing works, and specifically how ordinary long-term investors can use options for portfolio protection rather than speculation. Let us start with the most fundamental definition. An option is a contract that gives the buyer the right, but not the obligation, to buy or sell an underlying asset at a specific price on or before a specific date. Read that again slowly. The right, but not the obligation. That distinction is the entire conceptual foundation of options. You are buying the right to do something. You are not committing to do it. There are two types of options: call options and put options. Understanding these two building blocks gives you access to every option strategy that exists. A call option gives the buyer the right to buy the underlying asset, a stock, an ETF, an index, at a specific price called the strike price, on or before a specific expiration date. Buyers of call options profit when the underlying asset rises in price. If you buy a call option on Apple with a strike price of $150 and Apple rises to $200 before the option expires, you have the right to buy Apple at $150, a $50 per share profit on your option. A put option gives the buyer the right to sell the underlying asset at the strike price on or before the expiration date. Buyers of put options profit when the underlying asset falls in price. If you buy a put option on the S&P 500 with a strike price of 4,000 and the market falls to 3,000, you have the right to sell at 4,000, a $1,000 per unit profit. This is why put options are so useful for portfolio protection. A put option on your portfolio or on a broad market ETF increases in value when the market falls. It is essentially insurance against a market decline. Now let us cover the key terminology you need to understand before going any further. Strike price, the price at which the option holder can buy or sell the underlying asset. This is fixed when you purchase the option. Expiration date, the date on which the option expires. After this date, the option is worthless if not exercised. Options can expire daily, weekly, monthly, or at longer intervals. Premium, the price you pay to purchase an option. This is your maximum loss as an option buyer. You cannot lose more than the premium you paid. In the money, an option is in the money when exercising it would be immediately profitable. A call option is in the money when the current price is above the strike price. A put option is in the money when the current price is below the strike price. Out of the money, an option is out of the money when exercising it would not be profitable at the current price. Most options expire out of the money and become worthless. Now let us talk about what drives option prices, because understanding this is what separates people who use options intelligently from people who lose money on them. Option prices, the premium, are driven primarily by four factors: the current price of the underlying asset relative to the strike price, the time remaining until expiration, the volatility of the underlying asset, and interest rates to a lesser degree. Time value is one of the most important concepts in options. An option that expires in 6 months is worth more than the same option expiring in 1 month, all else being equal. Because there is more time for the underlying asset to move in a favorable direction. As expiration approaches, the time value of an option decays. This decay accelerates dramatically in the final weeks before expiration. Implied volatility is the market's expectation of how much the underlying asset will move before expiration. Higher implied volatility means higher option prices. There is more uncertainty and therefore more potential for the option to expire in the money. When markets are calm, implied volatility is low and options are relatively cheap. During market stress, implied volatility spikes and options become expensive. This has a very practical implication. The best time to buy put options for portfolio protection is when markets are calm and implied volatility is low, not during a crash when fear is high and options are already expensive. Insurance is cheapest before the disaster. It is most expensive during one. Now let us talk about how ordinary long-term investors can use options intelligently. There are 3 specific strategies worth understanding at this stage. Strategy 1: Protective puts. This is the simplest and most direct use of options for a long-term investor. You own a portfolio of stocks or ETFs, and you are concerned about a potential market decline. You buy put options on your portfolio or on a broad market ETF like SPY. If the market falls, your puts increase in value, offsetting some or all of your portfolio losses. If the market rises, you lose only the premium you paid for the puts, which you can think of as the cost of insurance you did not need. The cost of this insurance varies with implied volatility. In calm markets, you might pay 1 to 2% of your portfolio value per year for meaningful downside protection. During periods of elevated volatility, that cost can rise to 3 to 5%. Whether the cost is worth it depends on your risk tolerance and how much of a decline you could psychologically and financially withstand. Strategy 2: Covered calls. If you own at least 100 shares of a stock, you can sell a call option against that position, giving someone else the right to buy your shares at a price above the current market price in exchange for receiving a premium payment today. For example, you own 100 shares of an ETF trading at $100 per share. You sell a call option with a strike price of $110 expiring in 1 month and receive $2 per share, $200, as the premium. If the ETF stays below $110 at expiration, the option expires worthless, and you keep the $200 premium as income. Your effective purchase price on the ETF has been reduced by $2 per share. If the ETF rises above $110, your shares get called away at $110. You participated in 10% of the upside, plus received the $2 premium, but you gave up any gains above $110. Covered calls generate income from your existing holdings. They are considered one of the most conservative option strategies and are approved for use in most standard brokerage accounts. Strategy 3: Cash secured puts. You want to buy a stock or ETF, but you think it might fall further before you are ready to commit. You sell a put option at your target purchase price in exchange for receiving a premium. If the price falls to your strike price, you are obligated to buy at that price, which is what you wanted anyway. If it does not fall to your strike price, you keep the premium as compensation for standing ready to buy. This strategy allows you to get paid while waiting to buy a position at your target price. It is the options equivalent of placing a limit order, but with the added benefit of receiving income while you wait. Now, the most important warning in this entire video. Options can be used conservatively for risk management, as we have described, but they can also be used speculatively in ways that carry very significant risk of total loss. Buying out-of-the-money call options as a way to bet on a stock rising sharply in a short period of time, which is what most retail options traders actually do, results in total loss of the premium the vast majority of the time. The underlying asset simply does not move enough in the right direction before expiration, and the option expires worthless. The options strategies described in this video, protective puts, covered calls, and cash-secured puts, are appropriate for conservative investors. Speculative options strategies involving naked calls, leveraged positions, or complex multi-leg spreads carry substantially higher risk and are outside the scope of what this channel recommends for most investors. If you want to explore options further after today, the best path is to open a paper trading account, a simulated trading environment available at most brokerages, and practice with fake money until you understand the mechanics deeply before committing real capital. Options are a tool. Like any tool, they can be used skillfully to achieve a specific purpose or clumsily in ways that cause damage. The difference is knowledge and intention. Next week on The Algorithm Investor, Week 14. We are covering financial statements, how to read a balance sheet, an income statement, and a cash flow statement to understand the financial health of any company you are considering investing in. For everything you need to build real wealth, subscribe to the Algorithm Investor. New video every single week. Drop a comment below. Have you ever used options before? Yes, no, or curious to learn more? I read every single one. See you next week.